The warning signs for a recession are all around us. Consumers are tightening their spending. The Reserve Bank says unemployment needs to rise almost a full percentage point, and yield curves on government bonds are starting to invert. So how does our situation compare to other economies around the world? Well, joining me now is Dan Kemp, the Global Chief Investment Officer for Morningstar's Europe, Middle East and Africa region. Dan, thanks so much for your time today. You're visiting Australia at the moment. How does our situation compare to the UK and the United States?
Well, it's a similar global situation, of course, and all economies these days are plugged into the global economy, and particularly Australia as well, because of that link with resources. So everyone around the world is worried about recession, and we're hearing lots of concerns from central banks and others about what's ahead of us. But we need to remember that the future is not certain, that there's a whole range of possible outcomes, and economists are normally not very good at forecasting what happens next. So while, of course, there are noises about recession, while people are concerned, it's really important to think about that range of possible outcomes rather than get fixated on one possible economic scenario.
Yeah, I mentioned this in the intro, but the yield curve on government bonds in Australia and other countries is starting to invert. That is usually a telltale sign of a recession. I know economists don't like to stick their neck out and do sort of risky forecasts like this, but how concerned should we be at the moment?
Well, you're right. It is normally a sign, but when we think about what we do with that sign, are we business people where we're making capital investments? Well, they should be more long-term orientated. Are we investors? And if we're investing, it's not as simple as just following a yield curve sign as to know what you should do with your capital. And so it is a warning sign. The recession, a possible recession, is definitely something we should be thinking about when you're building a portfolio. Think about what impact a recession might have. But really, the point I'd make is it's not the only outcome, even with an inversion. And even if we get a recession, that doesn't mean that we'll see a predictable play out in asset prices.
Yes, so what are you doing to change your investment strategy to kind of deal with this economic slowdown?
Yeah. So one of the things that we're doing is looking at where the value is in markets. So we are long-term, valuation-driven investors. So we're constantly thinking about what offers that long-term value in the future. And as we look at markets at the moment, there's less to go for than there was in the past. And some of the assets that are normally quite resilient to recessions don't look great value. They don't look terrible, but they don't look great value because many people are focused on recession. On the other hand, we've just come off a period where inflation-linked assets have done really well, so they're highly priced as well. So investors are having to be much more creative in this part of the cycle they've been in the past, because it's been a little bit easier to be able to pick sectors that have been more attractively priced. But right now, there's a lot of clustering. A lot of sectors are near fair value, so there's not an enormous amount to go for if you want to look out for returns in the current situation.
So do you look at your investment approach on a sector-by-sector basis, or do you have more of a macro view looking at maybe what a nation's output can do?
Well, that's a really good point. So we don't think about macroeconomics very much. We don't see that as a guide to investing. We just see it as a series of risks. But we do look at the world through both a sector-by-sector perspective and then also on a country-by-country perspective, an industry-by-industry. We try and slice and dice the world in as many different ways as we can. And as we look at the world at the moment, actually, it's really in the countries we're seeing some of the best relative value opportunities. As sectors have clustered together, some countries have moved further apart, with some offering much better value than others.
So what countries are you actually looking at right now and going, they look pretty good?
Well, as we look at different parts of the world, emerging markets offer some of the most attractive opportunities, and specifically within emerging markets, countries like China, which has been pretty unloved for obvious reasons, and Brazil as well, they're offering good opportunities for investors in our view. Doesn't mean that you're going to get returns tomorrow, but as long-term investors, they look pretty good value. On the other hand, within Europe, most of the countries there look pretty poor value, but the UK still looks pretty good. Germany still looks pretty good. Again, that went through a pretty tough time when everyone was worried about the end of globalization, but we're seeing some good value in those markets. In the opposite perspective, the US is still looking pretty attractive. It's not, pretty expensive. It's not nearly as expensive as it was, but still reasonably expensive compared to other countries around the world.
And what about South Korea with its big computer chip industry? There was a bit of a boom with computer chips a couple of years ago. That's now cooling off. You're still positive on South Korea?
Yeah, that's absolutely right. It's been through a real cycle there where it went from being very unloved and therefore very attractive from an investment perspective. It then became much more of a mainstream investment idea as people were focused on chip manufacturers. But again, with that long-term perspective, it's now offering good value again. When people think about chips, when they think about technology or even a career as a country, they become very short-term oriented. They focus on the semiconductor cycle. But really, as an investor, you need to look through that short-term cycle into what's beyond, what's 5, 10 years' time, where the focus is there. And over that sort of time period, then South Korea looks a pretty good place to invest.
And your clients, are they sort of confident in looking through long term, or are they feeling a bit hesitant right now with investing capital?
Our clients, all investors, seem to be feeling pretty nervous at the moment. We ran a poll just earlier today, and the big concern among clients is recession. So people definitely have that glass half empty perspective at the moment. But as we look at the world from a valuation perspective, it doesn't look that bad. It doesn't look a great time to invest. Normally, the great times to invest come when everyone is panicking, when the prices are really low. We're not there at the moment, but certainly people are feeling a little bit morbid, and so we're seeing some reasonable values in the market.
Dan Kemp, Chief Investment Officer at Morningstar. Thanks so much for your time today.